Hi, and welcome to the third quarter 2025 investment update from San Diego Foundation. Very thrilled to be here with you today to introduce my colleague in the investment team. Colleen Smiley is with me today. Colleen has over 22 years of investment experience and joined us from Makita about a year and a half ago. So welcome, Colleen.
Thanks, Matt.
So I've invited Colleen here to join us, and you will be seeing more of her in the future as we do these updates. So moving forward, on to the third quarter, inflation did fall to about the 3% level, and the market figured out that perhaps tariff-based inflation was really more of a one-time effect and not necessarily a longer-lasting effect on inflation. At the same time, we saw strong results out of the labor market, but some weakening, and we had the Fed cut interest rates 25 basis points for the first time in some time during the month of September. We had a very strong stock market rally, and that was global. Emerging market stocks led the way for the quarter, followed by international developed stocks, then followed by the US. So the US was not necessarily the primary driver of returns as it has been for a number of years now. International stocks have performed very well. And part of that is based on the fact that the US dollar has stopped increasing in value, if you will, and stabilized to some extent. Not quite ready to say that the dollar is devaluing or if that's going to be a longer term trend, but certainly there has been some stabilization. So with that, I'm going to hand it over to Colleen to provide an update on the investment portfolios.
For the quarter, the endowment portfolio returned 4.6%, closely aligned with the benchmark's 4.8% return. Strong performance in U.S. large cap equities, particularly those benefiting from the continued AI-driven technology rally, played a meaningful role. Active management, though, has faced some challenges in this environment, which contributed to some underperformance relative to the benchmark. While U.S. small cap stocks experienced a broad-based rally, our managers in that area lagged. Year-to-date results continued to slightly trail the benchmark for the same reason. As Matt mentioned, though, on the international side, developed markets performed very well, with international small cap being a standout. Emerging markets managers also delivered strong results, driven largely by positions in Taiwan and Korea. In our private investments, real estate continues to be the primary detractor, an ongoing trend over several quarters. However, with the Federal Reserve's recent rate cut, as Matt mentioned, we may begin to see improvement as lower borrowing costs work their way through the market. Despite these headwinds, the portfolio generated a solid 10.7% net return year-to-date, compared to 11.1% for the benchmark. The long-term portfolio returned 5.5% for the quarter and 13.3% year-to-date, performance that was in line with the benchmark over both periods and ranking in the top quartile among peers. Similar to the endowment portfolio, U.S. large cap equities were the biggest contributor, while small cap and international equities created some drag. Their portfolio's allocation to public real assets, which includes commodities, natural resource equities, infrastructure, real estate, and inflation-linked bonds, added value both year-to-date and over the trailing one-year period. With nearly 75% of assets allocated to fixed income, the medium-term portfolio performed slightly ahead of its benchmark for both the quarter and year-to-date, posting returns of 3.5% and 9.1% respectively. Because the portfolio has a smaller allocation to equities, the rally in U.S. large caps had less of an impact here. Instead, strong results from our bond managers, who continue to benefit from the Fed's rate-cutting cycle, were the primary driver of returns. The portfolio's modest allocation to real assets also performed well, earning nearly 12% year-to-date. The intermediate-term portfolio generated a 2.1% return for the quarter and 6.3% year-to-date. This portfolio also outperformed its benchmark thanks to strong results from both core fixed income and low-duration bond managers, an area that has especially benefited from declining interest rates. The short-term portfolio, which as you'll remember is solely invested in money market funds, posted net returns of 1.1% for the quarter and 3.2% year-to-date. Returns for the portfolio are slowly reverting to the longer-term averages as rates continue to be cut by the Fed. This phenomenon is expected given the portfolio's investment allocation, which is more directly correlated to Treasury yields driven by the Federal Reserve's decision on rates. Our sustainable portfolios returned 5.2% for the quarter and 12.5% year-to-date. Their higher equity exposure has helped them outperform both the endowment and the long-term portfolios over these periods. The recent shift toward a more passive equity allocation has also contributed to performance that tracks more closely with the benchmarks.
Once again, I just want to thank Colleen for joining us and providing that update. You'll be seeing more of her in future quarters.
Happy to be here. Thanks, Matt. And thanks for joining us for our Q3 update. If you'd like more information on our investments, you can always go to sdfoundation.org/investments. See you next quarter.